point in time. Let's welcome in Nilesh Shah of Envision Capital, who's with us for a quick chat on things. Nilesh, your first brief look at the market as we had today on Friday, and of course all the news flow with regards to all these budget changes. Very briefly, what did you make of them?
Well, I think it just proves one point that market does not like any bouts of uncertainty. Markets don't like any kind of tinkering and any changes which probably could hurt investor returns and things of that kind. So it can take some time for the market to be able to absorb all of this and move forward. But I think in an environment which anyway is impacted by a lot of things which are, I would probably call them as a bit ugly globally, I think, and then on top of that, if you have a bit of tinkering here and there on the domestic side, it just impacts the sentiment further.
Nimesh, very interesting compilation over there. Nilesh, wanted to pick on that point about HDFC AMC. The developments which have taken place today have resulted in a knock in the stock prices, down close to about 5%. You like HDFC AMC. Do the developments alter the investment thesis in the AMC companies?
Well, in the very short term, it definitely is negatively impacted. I think this will impact maybe from a few quarters perspective, maybe 3 to 4 quarters. There will be some bit of impact. In addition to that, there's also the overhang that there's an expected change in the total expenses ratio that's already been talked about quite a bit. So I guess that still they will have a bit of a challenging time for a few quarters. But my sense is that I think it makes sense for investors to take that in their stride, because over the very long term, the long-term investment case for an asset management business, for a mutual fund business in India, I think is very solid, very robust. Penetration levels are still extremely low and have a long way to go to catch up even with some of the global emerging markets. So I clearly think that it's hard to come across a business where you can see compounded double-digit growth over a 5 to 10-year period with very high ROEs. I mean, the business is extremely capital efficient. So I think in the short term, I clearly think this is a bit of a negative, but maybe from a 1 to 2 years out perspective and beyond that, I still think this is a wonderful opportunity. You buy great businesses when they're facing the most difficult times. And we've seen this in the past, many great businesses getting impacted due to short-term sentimental reasons or a bit of changes here and there. But in the long term, the business is so solid that they end up being long-term compounders and long-term winners.
Okay. And between the large caps and the mid caps, which one would you favor?
Well, Rima, it's a bear case for large caps and a bull case for mid caps in IT. That's the way I would put it. The large cap, unfortunately, I think they'll find it difficult to grow in double digits. At best, their growth will be in single digits. Even in a year like financial year 21-22, which was the best year for IT, a company like Infosys, probably the net earnings grew at just about 15-16%. So imagine your best-in-class company in your best year growing at just 15-16%. So we can imagine that when things normalize or in not so great years, the growth rates are going to be significantly lower. So it's pretty much like the FMCG space, where the large companies will find it very difficult to grow in double digits. And therefore, it makes sense to probably kind of take a look below the top 4 or 5 names and see where there's kind of incremental growth happening, where there's going to be a higher delta and therefore a higher alpha generation over the medium term. So I think at best, if there were to be a further correction, the large caps will give you nice trading bounces. But probably, I think the big upside is going to be in some of the mid caps, which are growing at a much faster pace.
Interesting point, Nilesh. Well, there's still more to go. Would you look at this space?
Yeah, we've been constructive on this space, and it's clearly been one of the outliers of whatever you could call in terms of revenge travel or the way the consumers have behaved post-COVID. So clearly, this has been a standout sector. And it's yet showing the strongest signs. I mean, yet it continues to kind of be very robust. Like what you talked about, there's still some room for occupancy levels to improve. ARRs are very strong. So what it looks like, at least, is that for the next 3 to 4 quarters, or for at least financial year 2023-24, it's probably one sector where you'd still see double-digit earnings growth. The big challenge for them would be beyond FY24, because I think they would pretty much run out of capacity. And unless they kind of have some new capacity coming up, they won't be able to kind of demonstrate the growth momentum. So I think it looks good for now for another 2 to 4 quarters. Beyond that, I think they will face some kind of a plateau because they'll run out of capacity.
I can attest to that. I was in Odisha for a short break, and in Puri we want